When you're looking to invest your hard-earned money, your financial advisor is likely to recommend a number of options, including exchange-traded funds and mutual funds. Exchange-traded funds and mutual funds contain a lot of similarities, which can confuse a potential investor easily. However, some key differences set them apart. Many investors don't have a preference when it comes to picking amongst the two. Both ETFs and mutual funds entail a variety of different assets and represent a common avenue for investors to diversify their portfolio. Depending on your financial goals and investment time frame, you can use both of them together and use them wisely to build an investment portfolio. In this episode, we'll discuss the key differences between these investment vehicles. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best strategies to apply on your chosen investment option. Let's first take an overview of both platforms. What is an ETF? An ETF, or Exchange Traded Fund, is an investment vehicle that pools money from investors and uses the funds to buy a basket of stocks, bonds, and other securities. Investors can buy and sell shares of an ETF just like they would buy shares of a stock from a stock exchange such as the Nasdaq or the New York Stock Exchange, hence the name Exchange Traded Fund. ETFs commonly track a market index or commodity. Those tracking an index are called index funds. However, there is a growing number of actively managed ETFs. An active fund manager tries to outperform a benchmark index by being more selective with their stock picks. In exchange for the convenience of an ETF, investors pay a fee to the fund company in the form of an expense ratio or a percentage of assets under management. For heavily traded broad market index funds, where the fund's manager's job is relatively simple, the expense ratio can be very low. For actively managed funds, where investors are paying for expert research and allocation management, the expense ratio climbs much higher. What is a mutual fund? A mutual fund is an investment vehicle that pools money from investors to buy a basket of stocks, bonds, and other securities. Investors buy shares of a mutual fund directly from the company issuing shares, such as Vanguard or Fidelity. Mutual funds are more often actively managed compared to ETFs, but you can also buy mutual funds that track a market index. Again, index funds will generally have lower expense ratios than actively managed mutual funds, and the expense ratios are often identical to their ETF counterparts. Since you must buy and hold shares of a mutual fund with the fund company issuing the shares, you won't be able to move the assets to another financial institution without selling. Now, let's take a closer look at how the ETF and mutual funds compare. 1. Management styles. One of the main differences between ETFs and mutual funds is their management styles. Typically, mutual funds are associated with active management and ETFs with passive management. Active management may be more appropriate for certain asset classes or if you want your investments to try to adapt with changing market conditions. Passive management may be more appropriate if you're looking to be more hands-off and let your investments sit and weather market fluctuations over a long period of time. While there are many thoughts on the debate of active versus passive management, it's important to find an investment strategy that is suited for your specific goals and needs. 2. Management costs. You should also consider the costs associated with managing your investments, commonly known as expense ratios. Actively managed funds that have professional asset management usually have higher expense ratios than passively managed funds. These expense ratios are used to pay for fund management, administrative expenses, and other costs. Some mutual funds have discounts known as breakpoints. This means that your expense ratio may be reduced if you invest larger amounts of money. Mutual funds may also come with sale charges and other commissions when you buy or sell your shares of the fund, so be sure to check to see what requirements and fees are associated with the fund before you invest. 3. Trading patterns. The other major difference between ETFs versus mutual funds is how they're traded. ETFs, as the name implies, are traded on an exchange. This means that shares of the ETF can be traded throughout the day, during trading hours, and in real time. Share prices of the ETF may be directly impacted by supply and demand. For example, if many people sell their shares of a particular ETF, that ETF may be seen as less valuable and its share price may drop as a result. On the other hand, open-ended mutual funds buy and sell shares in a direct transaction between the investor and the fund company. Unlike ETFs sold on an exchange, when an order is placed to buy or sell shares of a mutual fund, the fund company waits until the end of the day when the NAV is determined, then places the trade. 4. Capital gains tax. These two options also differ in terms of the way they are taxed. ETFs tend to be more tax efficient than mutual funds. The investor usually doesn't have to pay a capital gains tax unless the shares are sold for profit. Actively managed mutual funds can incur capital gains tax due to the way they are structured. The fund manager may buy or sell investments within the fund. When investments are sold for a gain, the capital gains tax will be passed on to everyone who owns the shares of the fund, even if you never sold your shares. 5. Transferability. When an investor decides to move their managed portfolio to a different investment firm, a complication can arise at that time. In the case of ETFs, the transferring is very clean and straightforward while switching investment firms. They are considered as portable investments. For mutual funds, transferability is a bit complicated. One needs to close the fund positions before transferring the funds to different investment firms. This might be a problem for investors, as some untimely closure of investments can result in losses. 6. Entry minimums. Funds may require you to invest a certain amount of money to get started. Some mutual funds may have investment minimums that can range from hundreds of dollars for beginner funds to tens of thousands of dollars for more advanced funds. There are some mutual funds that don't require minimum investment. However, they may have other requirements like holding the fund for a certain period of time. If you sell your shares before then, you may be charged a fee. ETFs may be more accessible because you can buy them on an exchange with the minimum amount being the cost of one share. Some investment brokerages allow you to trade fractional shares, which means you may not even need the total cost of one share to invest in the ETF. Which is right for you? Understanding the differences between ETFs and mutual funds can help you decide which is best for you. Use ETFs if tax efficiency is important to you. If you're investing in a taxable brokerage account, having more control over capital gains distributions may be a deciding factor. If you're investing in a tax-advantaged retirement account, tax efficiency is a moot point. You're an active trader. You like to set limit orders and stop limit orders or use margin in your investing strategies. These options are available because ETFs trade just like stocks, but you can't use these strategies with mutual funds. You want to gain low-cost exposure to a specific market niche without researching individual companies. A lot of ETF options benchmark niche market indexes. While you could gain exposure through mutual funds, they're often less tax efficient or rely on active management, increasing their costs. You may change brokers in the future. ETFs are easily transferred between brokers, but you typically must close mutual fund positions before changing brokers. You would then have to reinvest the proceeds into mutual funds offered by your new broker. Use mutual funds if a comparable ETF you're considering is thinly traded. Limited liquidity for an ETF could result in enlarged bid-ask spreads, often requiring you to pay a premium above the fund's net asset value. Mutual funds are always priced at net asset value. You value the potential to outperform the market through active management. While actively managed ETFs exist, they're few and far between. Most ETFs are index funds, which simply match the market return. To outperform an index, you need active management. Keep in mind, however, that these funds typically have higher fees and higher tax implications, and you're not guaranteed outperformance even with active management. You're investing in less efficient parts of the market. Actively managed funds have the best potential to outperform in these areas. Highly traded markets such as large-cap US stocks are very efficient, but sectors with less trading volume have much more potential to benefit from active management research and strategy. That's it for this episode. Please give us your feedback in the comments section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.